Hello, today I'm joined by Greg Smith, Chief Executive Officer of IP Group. IP Group is one of the UK's leading investors in science and innovation companies with a real focus on building businesses who create a better future for us all. Greg, many thanks for joining me today. Last time we met, you talked about the fact that you had some interesting catalysts, some interesting exits running up. We've now seen a stabilisation in the NAV and some interesting valuation events. Can you talk through the progress of the last 6 months or so?
Good to see you, Dan. Thanks for having us on again. When we met last time, I said there were sort of a few signs of green shoots, and fortunately, a few of those have sort of gone from green shoots to a tree, if that's not extending the analogy too far. So we were really pleased to announce towards the back end of the first half of the year that we sold one of our top 10 businesses, great business, Garrison, ultra secure cybersecurity for networks, so customers in the Department of Defense and the UK MOD, and we sold that business to private equity in the US. Good multiple, decent multiple, and it was about the level that we had it in the books at, so about NAV, and that returned about 30 million of cash. And then in September, just after we announced our half-year results, we had what was actually our record cash exit. We sold a business called Featurespace, one of our top couple of holdings. Amazing business, really, really good. This is what IP Group is all about. We were the first investor in Featurespace back in 2012. John Eddington, one of our partners, was on the board, and we supported that business through 7 funding rounds and invested a total of about 24 million. When we sold the business, we were the largest shareholder, and we made a return of about 6 times our money, about 30% IRR. So brilliant financial return. And still subject to completion. So there's a few regulatory things that need to go through, but that will put us in a strong financial position. But sort of, I think definitely worth reflecting on, what is it that Featurespace does and why is these sorts of things so important? So Featurespace applies machine learning and AI to preventing and detecting fraud in the payments market. And we discussed last time, the terrible things that cash, which is taken out of the system for terrorist financing and trafficking and, sort of really big, significant problems. Something like 40% of all the crime in the UK is connected to fraud. It's a really big problem. And what Featurespace does is it reduces down the incidences of fraud and it removes the false positives. And so if you're a NatWest customer, for example, your chances of detecting fraud by NatWest are increased by more than 100%. So there's like billions of transactions that are protected each year by Featurespace technology. So to create something which is really impactful, but also delivers a great financial return for our shareholders is exactly what we're all about. So we're very pleased with that, with those outcomes.
Yeah, no, impressive exits. How does this leave the shape of the portfolio now? You've had, exits from your top 10. And what does the portfolio look like in terms of maturity, sector split, and so on?
So the common thing about our portfolio is we are backing businesses that have a very strong USP, which is built around IP, patents or trade secrets, but something which gives them a competitive moat. And as you know, we do that across 3 sectors: clean tech, deep tech, and life sciences. And actually, because we've been successful with our exits, the deep tech portfolio, the focus on that now is more to help those companies that are a little bit further back in the journey to go from maybe a few million revenue to scaling. So there's a number of great businesses in there. We've got some applied AI, we've got some novel chip technology, some novel memory companies. So that the job there is to do the scale and get some of those companies to the same scale as Featurespace and Garrison were. But the reason we operate across 3 sectors is because at any point in the cycle, some of them are going to be in this sort of investment phase, some are going to be in the scale phase, and some of them in the exit phase. And so in the life sciences portfolio, we have about 14 companies that are in clinical trial stage. So they're testing various stages of development for new drugs. And that portfolio, we're not doing new investments into new drugs at the moment. What we are doing is providing capital to get those companies through to their milestones. And it was really good. We had just a couple of weeks ago, an exit was announced, Kainos Therapeutics, which we invested in a couple of years ago. We exited that position to a specialty pharma company in Germany. Made about 2.5 times our money, so a really good IRR. and just some good validation that as these companies come through their clinical trials, we're able to monetize those. So there's different stages of maturity, but it's that's the reason we sort of operate across a few different sectoral areas.
Get you. So in terms of the near-term catalyst, more life sciences weighted than tech.
Yeah, there's some. I mean, as always, there's all fascinating stuff in the IP Group portfolio, which is addressing very big problems in the world with novel technology. The company which probably offers the nearest term milestone is a business called Estesso. We own more than half of that economically. And this is a company which has got a drug in trials, in phase 2B trials for rheumatoid arthritis. Huge market for drugs that are in immunotherapy, tens of billions a year. But if the data that come through from that trial sort of support some of the things we saw in the early trials, which was actually sort of removing and reversing the painful effects of rheumatoid arthritis, and indeed reversing the course of the disease rather than just treating the symptoms, we could have something really special there. So that's definitely interesting. And then something we haven't spoken about for ages, there was a rumour about one of our companies in the press potentially gearing up for an IPO. So perhaps another sign that markets are moving in the right direction.
It'd be great to see some more IPOs hit the market. And what about your financial position? You're about to receive the cash from Featurespace. How are you going to deploy that capital?
So Featurespace, as I mentioned, it's subject to some sort of customary closing conditions. Visa were the acquirer, and when they announced the deal, they said it would fall within their fiscal year, which actually runs until the end of September next year. We would anticipate probably in the next few months that those can, all being well, that those conditions would be met. And that would mean we'd receive more than 100 million cash. There's a little bit of tranching, but more than 100 million cash. So assuming that falls in the beginning of next year, then at that point we'd have around sort of 280, 300 million of cash, which is a healthy position to be in, probably puts us in the position to be able to fund investments for the next couple of years. But also, and importantly, what I've said for the last couple of years is we will have a proportion of all of the exits that we make from the portfolio will be used to give some cash returns to shareholders, and also been very clear that when our discount is more than a 20% discount to our NAV per share, that will take the form of buybacks. We've done 20 million of buyback already this year, retired about 4% of our shares, and we're in the process of doing another 10 million that came from the exits that we'd had already this year. So before Featurespace, we're currently tracking at just over 50 million of realizations. We'd set ourselves a target to achieve 50 million, and I said that was a big focus for us this year. So I'm very pleased to be able to tell shareholders that we've delivered on what we were set out to do. It's not always easy, you can't sort of magic realizations, but a lot of hard work from the team and grown some good companies. So it will put us in a position to both reinvest, probably little on the new investment side. Most of it is in scaling and getting those companies through to the point of maturity and exit, and also to meet our commitments on returns of cash to shareholders.
And today we've got the Mansion House speech with the announcement of the consolidation funds into a mega fund, really with the view to invest in growth businesses, infrastructure, and so on. What are the implications of that for IP Group?
I hope very positive. I think the pooling of these slightly smaller scale funds into larger funds has many benefits. I think it will have benefits for, most importantly, pension savers. Ultimately, pension money is there to provide a return to pension savers, but the long durations involved means that you can put a proportion of that into productive assets. And this is money that's invested over 10, 20, 30 years. Some of that can go into productive assets, infrastructure assets, private equity, and venture. The amount that goes to venture as a proportion should be quite small. But if you can bring together more than $1 trillion of capital into one pot, then your ability to be able to allocate some of that capital into venture increases. And so we should be beneficiaries of that. Now, the reason I say we should be is because we've got some great experience of managing this sort of capital. So for the last 7 years, we've been managing scale-up capital for one of the biggest superannuation funds in Australia. And the superannuation fund in Australia entrusted us with managing some of their capital for their members. And we've invested it into many growing businesses, most of which are here in the UK. So there is a great opportunity here to give returns to pension fund savers, to help scale businesses in the UK with a bias towards some home capital. But also, if we do that, the flywheel effect that can be started, where you have entrepreneurs who have successful businesses that they grow, they gain experience, they gain personal capital, that is additive to the economy, and then they go again. And we're starting to see evidence of successful entrepreneurs in IP Group coming back in and helping to guide us to create better returns in the future. So we're really positive about those announcements, and this could be the moment that sort of unlocks some real long-term capital for the UK.
Yeah, it definitely seems like a positive evolution. Let's hope it happens quickly rather than slowly. Greg, many thanks for joining me today.
Very good to see you.